Good afternoon and welcome to this week's market update through SONAR with Zach Strickland and myself, Brad Ganane. Before we get started, just a couple announcements. We're a few weeks out for our event, MarketWaves 18 in Grapevine, Texas. We're going to be doing actually some training sessions there for SONAR, and we're also going to be doing some freight futures training sessions as well. Which we're pretty excited about to have some engagement with our customers there. Today, we're going to keep the same form that we've had the last few weeks for the webinar. Going to do roughly 30 minutes of introduction of a few new data sets that have been added, a little market analysis of what's going on in the U.S. freight markets, and then we're going to open up for some Q&A at the end there. The Q&A again at the top ribbon of your meeting here. With that, I think Zach's going to get us started with the latest additions in SONAR.
Yes, so we have added a totally new section of index categories to SONAR this week. Some of you may have already noticed, excuse me, the energy section has been added down here at the bottom. And this is going to be the first in a series of commodity additions that we're going to have coming up. There'll be a lot of agricultural commodities coming in over the next few weeks, so stay tuned for that. But this first section is the energy type commodities. A lot of these are fuel market derivatives and various other things that are related to the fuel market, fuel oil price, ethanol production, gasoline stocks, gasoline retail price, and you can see electricity price down here. I think for most of us, the most interesting data point on here is the WTI crude spot price. A lot of you may already be looking at this elsewhere. I know it's available elsewhere, but it's nice to have it available in the same kind of place because you can actually overlay this onto some of your, other data sets of interest. I think it's fun to find correlations with things that seem unrelated. I know I overlay a lot of these different values onto some of these transportation stocks that are also available in here, and transportation type indices. And sometimes you find some unique relationships. So yeah, this is probably my favorite one here, but we'll go down the list real fast. So some of these I'm not overly familiar with, so I'm not going to pretend like I am some sort of crude oil expert that's been fracking since I was a wee lad. But the crude oil first purchase price. So essentially, once the refinery presents the oil, this is basically the first price that they give to the purchaser of said crude oil. So that kind of sets the market in any given month. And that's kind of, for a lot of the people that are heavily involved in the oil fields and refineries and oil production, this is a pretty big number to have. Crude oil production, again, it's kind of the production volume, just like that's the price, that's the production number. So it's volume of barrels on a weekly basis. Distillate fuel oil stocks, distillate fuel oil net production, ethanol stocks, ethanol production. A lot of these are really, fuel oil price, this is kind of heating oil related. A lot of these are just different versions of crude oil and its derivatives thereof. So it's basically volume and price for each kind of derivative fuel product off of crude oil. And then you have the WTI spot price, which is the spot market price for the West Texas Intermediate, which is all that fuel that they're out there pulling out of the ground in Oklahoma and Texas, West Texas. That's kind of the one that we're kind of benchmarked off of in America. We have a couple of oil fields that are not located in that spot of the world. There's oil fields in the Midwest and North Dakota, for instance, but just not at I think they produce like 300 million barrels in the West Texas Intermediate. So it's far more significant down there. So that's where we're kind of judged. A lot of people have heard the Brent market, and that's kind of where the spread between the two is generally what people measure in terms of oil, like oil price and the globe, for instance. So right now, I'm going to go ahead and pull up the WTI spot crude price because I think
so that spot crude price is just for the US. I know we have some granularity with these energy data sets. Are they, for the most part, how are they being displayed?
so. A lot of them are divided up into kind of the regions that they're most relevant in. The majority of them are PAD regions, which is the Department of Defense's kind of geographic segmentation of the United States. You can go to the Department of Energy and get like a full on map and layout of what each of those regions are and their definitions in a map. It's very easy to see. Most people that have been looking at the DOE fuel price over the past several years, they have the same thing available for the, ultra low sulfur diesel price at the retail level. But yeah, that's that. Some of these do not have that kind of granularity because it's not relevant in those areas. WTI, it's kind of the benchmark price, 71. It's been going up relatively quick. But again, you can go all the way back. I believe we have at least till 2014. And go back any further, I think 2008, it was actually at $130, something like that, a barrel. But we still got a ways to go. A lot of people follow the oil market because it leads industrial production. When you have a lot of oil production in the country, that tends to mean that you're going to see significant amounts of industrial production activity because there's all these derivatives that come from the oil market, such as plastics. Obviously, when people have lots of, gas, they need a lot of gas and things like that. That means people are spending money. Various products are moving throughout, and the higher they need this rate to be high enough to where it makes sense to produce this, to produce crude oil. If it falls below $40 a barrel, for instance, the shut down because it doesn't pay enough to produce the oil. So therefore, they'll just shut it down, and that's terrible for the United States. That does not help with the economy. Back here in 2016, you can see this actually in action. So 2016, spot price fell way down here below $30 a barrel, or below $40 a barrel. That was one of our worst years since 2009, I would say. So that being said, for those of you that are interested in the energy and oil and crude production, we do also have some other indices related to fuel that we don't have lumped in there, such as the ULSD, which we just put in there not that long ago. I believe it was in the past few weeks. And this one we put in the volume just because we do feel that there is some sort of correlation between rack volume, ultra low sulfur diesel, and truck availability and movement in the country. So whenever you see a big spike in volume or a movement or change in volume over a 7-day period, for instance, you can kind of assume that there's either anticipated or actual truck movement in that space. And then we also have ultra low sulfur diesel price, which is up here in the price trends, along with the DOE, because these things directly impact the rate of transportation. And that's kind of why we grouped it into the price area. And not necessarily in the energy sector, because the energy sector you need to think about is kind of the section of things that are leading, or they kind of get in front of the market itself. These are production level values that help you kind of judge longer term trending and forecasting.
Yeah, and the ULSD, that info is available at the X market level, I believe, for volume and price, so a little bit different.
Well, all you have to do, Brad, nowadays is click on this little plus sign here, and you can actually expand that into all available granularities.
Wow.
One of the new features that we've added in recent weeks that I think is wondrous.
That is fantastic.
It definitely helps me navigate the SONAR sphere.
Yes, that's a SONAR data team plug. So nice job, guys.
Yeah, they did do a really solid job there, as well as the UI team. They did a good job with the.
Yes, they definitely did. I think I would have to agree, and along the lines as we mentioned briefly. So the energy, that's first in line of the commodities that we're adding. I think we're going to have high interest in things like produce movements and ag, things of that manner that are going to be very, a lot of carriers, a lot of brokers, a lot of shippers are going to be very interested in seeing that in a place where they can overlay with their volumes, with sonar volumes, with rejection percentages on a cyclical trend.
All these commodities are going to have their own kind of mode of transportation that they impact. The oil market, for instance, is going to have heavy codependence with the flatbed side of things. So those that kind of deal a lot with the oil fields out there in Texas, I think a lot of us are familiar with the trucking congestion out in the West Texas area. Even though there's lots of space, there's lots of traffic in West Texas. So when those oil fields are cranking above the pipeline capacity, flatbeds get called out there, and tankers and stuff like that try to help expand that. And it creates capacity issues as well as traffic congestion. But more importantly, the energy sector really does kind of have an impact on the industrial economy, which is one of the things that has been driving this economic expansion over the last 2 years. Is we've had a very solid, stable, you can see here that it's been a stable growth in our oil market production. We become the biggest crude oil producer in the world in the last year, I think in the past several months. Yeah. We should have had Mike Mitchell, our market expert on oil markets, in here today to talk some of this through, but alas.
Alas, here you are.
Here I am. I hope I didn't get any of that wrong. So that being said, for those of you that have been in that kind of sector and industry will probably know more about what to do with it than I will. But the agricultural side of things, that'll be a lot of people that, have reefer specializations, a lot of flatbed interest on the ag side, as well as dry van, because these seasonalities that show up in the agricultural sector, I learned a lot actually in the past year about how much agriculture impacts freight markets across the country. You can have these little mini surges. We're about to see some actually in the Pacific Northwest.
Yeah. Well, look at that. That's a great segue. Why don't we jump in and let's take a look at what Sonar is showing us in the Pacific Northwest right now.
So this has fallen off in the last day. But
let's look at a map though, because I think the head haul index for that entire region, if I remember this morning, I think Portland and Seattle markets both having quite a bit of activity.
Pull up a nice map for us. There we go. So I've got the outbound tender rejection weekly change, but you can see here the Medford area. So what this map is doing is kind of telling you that the weekly change in outbound tender rejections, which is kind of the last line of defense in my mind for kind of increased or lowered capacity and increased rate pressure. Once carriers start turning down their loads, you start to see shippers kind of fall through their route guides a little bit. Something we discussed earlier in the week is it's not necessarily that things have to get into the spot market to have a realized increase in rates. Most shippers will have, a list of carriers. It'll be like option 1, 2, 3, 4, 5, depending on the amount of fleet that they want to have exposure to. Well, when they turn down when the first one gets turned down, they go to the second one. Well, the second one is either going to have some sort of, service or price, because those are the only two things that shippers are really concerned about next to kind of a relationship is, how good of a service are you going to offer me? And then I need my price to be as low as possible for that level of service. So once they start bouncing through the route guide, the rate tends to increase. So it's not that it's going to show up in the spot market, but your rate is going to go up the more times your load gets turned down. So if you have a high amount of tender rejections, you may not see that show up in the spot market in kind of, the DAT and all the other kind of rate models, but you will see it on the shipper level because they'll be paying a higher rate more than likely, trying to get their load covered. That was kind of something that I hadn't fully kind of thought through before.
No, I think that's a really interesting point though.
So some of these things you actually will not see, spot market kind of show up right away, but you will potentially see your rate increase if you're a shipper. So yeah, the Pacific Northwest over the last week or so, I pulled up Outbound Tender Rejection Index for Spokane, GEG. And for about 6-7 days there, we had this elevated tender rejection level. And a lot of this time of year is the year that the apples, we're right in the middle of the apple harvest. A lot of those kind of start surging here in the next couple of weeks because capacity kind of, fades out because retail season's about to hit. Seattle, it's like the only time of year that Seattle kind of starts becoming an actual legitimate like head haul versus a backhaul, because you can get out of the region. Right now we're looking at a -21 head haul index value.
A 22 increase on the week.
But it has, yes, exactly. It has gone up 22 points over the last 7 days. So that means that this market is starting to see a lot more outbound in relation to its inbound, which means that the carriers out there are going to have an easier time getting a truck out of this normal, like depressed market where you can't get anything out of. And we've been watching that happen over the last several days. Spokane, for instance, until today, had really been showing up as kind of a more heated market than the rest of the country. The market itself in general, though, however, and this has come up a lot this week, as we've kind of, there's a lot of mixed perception about what the month of October is in freight markets. And I'm going to go ahead and kind of pull up some of these longer run charts that we have, because this time of year, everybody thinks they know that October is always this or November is always that. When we pull up kind of, I'm going to pull up the Outbound Tender Rejection Index for the USA, which we have, again, celebrated a year anniversary. So now we have year-over-year data. Hooray to us. And so what this is telling me, again, Outbound Tender Rejection Index, for those of you that are somewhat new, it's the rate at which carriers are rejecting their electronic tenders. When they reject more of their loads, that means that capacity is unavailable, or they can get a better rate, or they have a better option somewhere else. Last year at this time, we were operating around 24% tender rejection rate. This year, we're operating at 13. So things have changed. Last year, we had the hurricanes. I know we've talked about this in the past. The hurricanes kind of had this big run up into the holiday season, which kind of snuck up on people. The market was destabilized before the holiday season. I'm going to pull up another one of our indices here, the DAT VF.VNU, which is an index kind of developed with DAT, by DAT, I should say, that measures rate volatility and rates effectively in the nation. Mm-hmm. This does not have fuel included in it, so it removes kind of some inflationary measures. Mm-hmm. It does not have team transits or accessorials built into it, so it is as clean of a number as you can get on a rate per mile basis, without any kind of external influences. If somebody were to throw in an extra detention charge or something like that, or something they build into the rate, this is cleaned out. A lot of that is cleaned out of this number. Mm-hmm. So what we can see over the last 5 years or so is every June and November, there's a big push. There's a big surge of spot pricing. Mm-hmm. And we've talked about this, where it's kind of perceived that these months, the June peak is kind of driven by volume. Well, the November peak is actually kind of driven more by retail and also just the circumstances of the season. Yeah. It's not necessarily that there's significantly more volume, because this time of year, the industrial sector kind of starts shutting down. It slows down a little bit. It's a very seasonal thing. Everybody knows January is a dead time of year because all of it's gone. Not just retail, but industrial stuff too, right? Because people are taking vacations. These factories shut down. And one of the things you can notice from the DAT and National Van Freight Index is that these peaks are very regular. And I would expect, even in a down year, which 2016 was, you still had the secondary peak in November, right before Thanksgiving. Mm-hmm. And it's not necessarily entirely volume driven. one of the things that we've been watching in October is that a volume has been suppressed in relation to the rest of the year. Well, that's not necessarily that, it doesn't mean that we're at the very end of everything and everything's going to go all the way back, but it probably does mean that we are slowing down as a kind of things are coming down off of 10-year highs. You cannot operate in this sector for too long at that elevated level without some sort of correctional movement. So I do think we can say we're going to see another little jump in rates coming up, because every single year it happens now.
And you don't think it's going to be as much volume driven though?
It never really is as much volume driven. It's more, so say you're a shipper, you have a limited window now. Like it's like you're playing you're at the 5-yard line, if I can make a football analogy. You have a lot less space to operate in, but it gets tougher and tougher to get into the end zone because you've got more people defending it. So in transportation, you just got less amount of time and less availability for people to handle your freight. The week before Thanksgiving, it's not just you that's going on vacation. A lot of these drivers are going on vacation because they're going to go and say, well, man, I'm shutting down my truck. Sorry. I'm going to go home for the holidays. I've been running my truck, 12 hours a day for the last, 10 months. I'm going to go see my family. Shippers are also, the consignees are also closed. So it's not like people are going to be sitting at warehouses waiting for trucks with as much availability. They need to be in the stores and ready to go for Black Friday. So that means that this week before Thanksgiving, everything has to go now. They don't have that normal kind of 2-week window of, well, I'll push out my end of the month freight. No, everything that's coming off the line needs to get moving right now before everybody goes on vacation. Everything needs to be in the store or the DC before this period. So they have a compressed window of time to operate in, because they also need to consider that it's going to be the end of a month. They need to get as much revenue pushed in. It's starting to be the end of the year. Everybody is operating like on all cylinders, trying to get as much out so they can go and take some time off and then buy a bunch of stuff at the store. So that actually has a bigger impact on the rate volatility in the late season than traditional trucking volume has, even though there's kind of this perception that there's a lot of volume, and it's going to feel like a lot of volume because you're going to have a lot more activity, a lot more urgency. If you look at the Cass Freight Index, for instance, which I find to really kind of follow a lot of the natural freight patterns, a lot of what you see here, and I'm going to go ahead and just change the display to the mountain to make this a little bit easier to look at. You can see every year we kind of have this, mid-year kind of peak. I mean, it varies. It builds up out of January and then it crashes back down in January. But we kind of come down in the fall. It kind of can waver. You can have a little bit bigger October every now and again, which I think is really the perception is we sometimes remember October was big one year, so it's always big. Well, it doesn't always have to be big, because inevitably here's November. And as we saw, those freight markets, the rates spike in November. It's not a huge volume month. It's kind of like they just need to get their freight out type month and get it moving. So that's what creates this, the lead time shrink. Anytime your lead time shrink, and that might be a good index to kind of watch in your particular market over the next few weeks to see, hey, what are my lead times looking like as I get closer to the holiday? And obviously they're going to start moving up here in the near term, but I bet you as soon as we get close to Thanksgiving, they're going to go down quite a bit, because they're going to just have to. They don't have a choice. Regardless, you can see them now. They're actually pretty low in the city of Atlanta. OTVI.USA. I'm going to move to that without some sort of segue, just to kind of give everyone an idea of what we're talking about when we're talking about how volumes have declined, because I don't think we really illustrated that. For those of you that haven't seen this chart, this is one of my favorite indexes that we have. It measures general volume in the U.S., but you can go into each market and look at any of those. What we're seeing right now is we saw this big drop off in volume at the 1st of October. It's kind of recovered and it's starting to flatten out. But if you remember, the tender rejections have gone down. So really, I think it's going to take more volume injected into the system to start creating that volatility that we need to see tender rejections start moving back up. Because if we're operating at 3 to 4% less volume in the market in general, you're just not going to have the chances. And think about it like a tightly dense, packed, space. The more dense that market is with activity, the more likely one of them is going to bounce into the other, and you're going to start seeing a chain reaction of capacity failure. Right now, we got a lot of room in the market. That doesn't mean that individual markets themselves can't have little bubbles that get popped, like we saw in the Pacific Northwest, for instance, in the Spokane market earlier in the week.
And I think the U.S. volumes is an important thing to understand when looking at, when running through that kind of daily process of looking at maybe your volumes or your head haul index and monitoring changes, and then seeing if the tender rejections are increasing or decreasing. Because I think what we've seen in a lot of markets recently, maybe not, the more obscure ones like the Pacific Northwest, but some of the larger ones like Atlanta, Dallas, and Ontario, is actually these increases in head haul index or increases in outbound tender volume, but no change or a continuing decline in outbound tender rejections. And, kind of what is that and why is that the case when 6 months ago I'm looking at SONAR and I'm seeing tender volume increase and then I'm seeing tender rejection follow very closely behind? Well, I think the outbound tender volume for the U.S. paints a nice picture there and showing how much available volume there is and that people are kind of flocking to these larger metropolitan areas.
Yeah, absolutely. I know Atlanta has recovered significantly over the last several weeks. It used to be a pretty depressed, in October, it basically just kind of fell off. I'll go ahead and pull up the outbound tender volume in Atlanta. One of the big, 5 markets that we look at here on a daily basis. You can see this big dive as we closed out September. Everything just kind of fell off. Well, Atlanta recovered really fast here in the middle of the month. And this is one of the key markets to watch as we progress forward, because Atlanta is going to have a lot of exposure to the retail sector. Because a lot of distribution happens out of this city. A lot of things come into this city. It's a high consumption city. So when you see this market kind of rise and fall, that's a big indication of what's happening in the broader market. And it has a lot of impact on the other parts of the country. Dallas, for instance, has really fallen off in terms of volume over the last several months, really. It's not quite as, you can see it's fallen. It had its moment here in June and July and then just collapsed. Again, these are things to kind of know. I like looking at the outbound tender market share in these areas because it gives me an idea of where the trucks are or where the trucks are needed the most in the marketplace. I pull out to a year here. You can see Atlanta recovered nicely, and now it's higher than it was in May in terms of outbound market share. And a few weeks ago, we were talking about it being super low and depressing,
And it makes sense if you look at how it's rebounded compared to a large market like Dallas and the fact that they've seen,
look at that
continuous decline.
I mean, that's a significant change in structure of a market. Like within a matter of days. I think most people look at freight markets in longer patterns. Like I know a lot of people, involved in the day-to-day operation kind of get their information a month later, and I don't know when, a market like Atlanta turns like this, capacity can fall off real fast when you thought everything was going hunky-dory. I mean, that's a huge percentage change right there. I'll go ahead and throw up one of our little tools. For those of you that are using SONAR, these tools that you see over here are very useful in trying to measure things on a chart. I know myself, I like to have things that will do calculations really quickly. And I use this trend line one to kind of give me a real quick calculation when I need it, because I'm used to calculating things in Excel and having something that'll do quick math for me. But this is a good tool right here to use the trend line bar, and it'll tell you over the last 15 days, that's what that bar is. And then, depending on the indice, it's going to be a week or a month or a year, depending on the index. But our tender market share is a daily value. So 15 bars equals 15 days. They have gained 17%, almost 18% more market share back. That's a huge turnaround.
Yeah.
2 weeks, and they jump up that much. Capacity can go away rather quickly, and especially this time of year. I think the market share is kind of the index to watch, along with head haul, because head haul is going to give you your kind of precursor as that outbound volume goes up in relation to the inbound volume. The more outbound volume that is occurring versus inbound is going to leave that market exposed over time to any kind of capacity surges in that area. Atlanta is showing me that there's a chance for the capacity surge, but that's where the haul kind of comes into play. I can see how is it doing in relation to and it is going up. So Atlanta looks like it's starting to heat up a little bit as we go into the middle of the fourth quarter, into the peak retail season, which is
important to know because there's not a lot of markets that you can say that about.
No. The market itself is very stable right now. We're not seeing a lot of heated spot market activity except for isolated regions. If we were given a weather forecast, it'd be that 30% chance of isolated capacity crunch. But Atlanta is probably put Atlanta in the 40 to 50% range here in the next week or two, if things continue along this path, especially as we enter heavy retail season, which tends to shrink the lead times and leave people a little bit more exposed.
Which these are good, leading factors to look at.
Exactly.
And as we enter this, what is the state of a lot of these markets going into this time of the year? When you talk about, Black Friday and Thanksgiving with time off, and then even going into Christmas, what's the state of these markets, and how easily can they be thrown out of balance?
Yeah, I think this time of year is as important to have near to real time data as any other time of year outside of probably early March, late February, because late March or early March, late February, you're really looking at a time where you don't know when things are going to start really kicking off. Like, you've had this slow couple of months, you're kind of lulled into this sense of like low volume. Then all of a sudden you wake up one morning on March 3rd and there's, 1,600 truckloads waiting on you out there. And it's because the shippers have their seasonalities as well. And all of them change every year. You may know that they're going to happen around that same time, but this time of year is worse because they're operating, they're slaves to what's happening further down the supply chain. All those containers that just hit the ports in September, for instance, they have to get decontainerized and, packaged, repackaged, and put into their respective warehouses. That takes a little bit of time. Those may go rail. A lot of them do go rail on the intermodal side, especially coming across the country. But after those get off the rail and get into their DCs, you see these huge pushes out into the retail space. So this time of year, having that kind of quick near time number allows you to be a little bit more in tune with what's going on in the broader market.
Yeah, definitely. And that's about all the time we have for today. I think we're going to go ahead and cut things off. Again, we're going to be doing SONAR training sessions, discounted tickets for our SONAR subscribers and SONAR potential prospects at FreightWaves November 12th, 13th in Grapevine, Texas. Michael Lewis speaking there. We're very excited. Also doing some freight futures training if you're interested in learning a little bit more about what that is and how you'd be able to do that. That will also be taking place at the FreightWaves 18 event. As always, any questions, reach us at sales@freightwaves.com or on the website here at www.freightwaves.com/sonar. Again, thank you guys for joining us.
Oh, and one more quick thing. We got a cool webinar happening tomorrow for a little bit more in-depth dive into the economics of what's going on right now and what we're seeing at 2 p.m., I believe.
I think
that's right. It'll have our chief economist, Ibrahim, and our chief data guy, Dean Croak from Australia, who he's
great.
Fantastic. If you have not heard him talk, you should definitely make time.
Absolutely.
So, yeah.
Good stuff. Thanks
All right.
again, guys, for joining us. We will see you next week at 2 p.m. Eastern for your Sonar market update.